the primacy of the dollar as the world's currency has been a very important part of making the system work and keeping the United States in a leadership position. And I don't see how you can have the primacy of the dollar and still have so much debt.
You are listening to CEO Perspectives, a podcast by the Conference Board.
Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of subjects that matter most to business leaders. I'm Steve Odland from the Conference Board and the host of this series, and in today's conversation, we're going to discuss the burgeoning U.S. sovereign debt. Joining me today is an expert on the subject, Dr. Joe Kasputys, the CEO of Economic Ventures, which creates and invests in early startups and early-stage information companies. Previously, he founded Global Insight, Decision Economics, was CEO of Premark, chairman of Thomson Financial, and the Assistant Secretary of the U.S. Department of Commerce. Prior to that, he served as an officer in the U.S. Navy. Joe, it is a privilege to have you join us today.
Oh, thank you very much, Steve. I'm very glad to be here and discuss the fiscal situation of the United States government, which is quite dire, I think.
Yeah, Joe, I think you're right. And everyone hears these stories about, okay, now we're at 34 trillion in debt, but we heard it when we were 10, and then we heard it when we were 20, and now we're 34, but nothing, trains are still running, planes are still going. So what's the big deal?
Steve, I think the U.S. federal government's fiscal situation is really quite dire. If you realize what's happening, you see it very clearly in the interest that the government is now paying on this $34 million of debt we've accumulated, which is growing at an exponential rate and is starting to crowd out other programs. A startling fact is that the net interest paid by the government this year on $34 trillion worth of debt is larger than the cost of the Defense Department, almost the same amount as Medicare. This year, it's estimated to be $870 billion in interest. And if we keep the programs we have in place, the entitlement programs, the tax rates, the spending programs, in the next 10 years, 10 years from today, in 2034, the interest bill is projected to be $1.6 trillion per year. That's a dire situation.
Yeah, and it may be conservative, Joe, because the current debt, is made up of new debt at current interest rates, but it's also old debt at close to zero interest rates, and as that rolls off, that increases. But at some point, there's got to be a downgrade to the debt, and therefore the borrowing cost should increase. And they're not figuring that kind of change into the future projections.
Well, the Congressional Budget Office, which I think is a very fine government organization, does really good work under the leadership of Phil Schwagel. They, about a week ago, just came out with their updated projections. They always do a 10-year projection each year, and so they added the 2034 this year. And that 10-year projection, just to emphasize your point, includes the assumption that the tax cuts of 2017 will not be extended past 2025. You may recall that in order to get the tax cuts through the Senate using the reconciliation method, this is a little technical, but there's a way in which you can get a budget bill approved through the Senate with just 51 votes if you can show that the 10-year cost would not be negative. So you can spend a lot of money in the first few years and run a deficit, but as long as you project that you're going to correct that deficit so that it averages out to be positive over the 10-year period, it can get through with 50 votes. So what they did is they they cut the taxes, but they said, well, it's only a temporary cut till 2025, so it expires. So in the Congressional Budget Office projections, they're assuming more revenues are coming in because of that tax cut will go away, which it's unlikely that it will. Who knows? Is what the Congress will do. But the one thing you can be sure of is the CBO projections are usually low because they are constrained by law to only assume that existing policies will continue. And something new always comes up. There's a crisis, a war, a huge storm like Katrina, a pandemic that causes us to spend more money than we anticipated. So yes, you're right, Steve. It is conservative.
So, but one way economists like to track the debt or express the debt is in terms of percent of GDP. Just explain that to us, and then explain where it is today and where it's projected to go, and why is that important?
Well, it's a useful standard to get an idea of the capacity of the country relative to the debt that it's carrying. Steve, it's very much like the rule of thumb of how much of your income should you devote to housing, and that traditionally has been 30 to 35% of income should be devoted to housing, but not any more than that. The same is true of governments. How much of the GDP should debt be? We typically have thought 60 to 70% was about as far as you should push it. In fact, the European Union had a rule when they were forming the union. They wouldn't take any country into the union that had a debt to GDP ratio in excess of 60%. Now, if you go back and look at the United States history, right after World War II, our debt to GDP ratio was 106%. Well, of course, we just had to spend all out for the war effort to mobilize. But the next thing that happened is we had peace. All the soldiers and sailors came back to the United States, married their sweethearts. We had lots of household formations. We educated them with the GI Bill, and we had a booming economy. And we rapidly paid most of that down, so that for a long time, as recently as 2000, the country had a debt to GDP ratio of 30%. In the year 2000, do you realize we were running a budget surplus and the Treasury was buying back Treasury bills? Larry Summers, when he was Secretary of the Treasury, announced a buyback program. We often hear companies buying their stock back. The government was buying its debt back and reducing its debt. 30% was the GDP ratio. What happened? Well, we went into the 2000 period, and then we had the financial crisis of 2008. We did a lot of deficit spending. I think it was handled fairly well to prevent a meltdown, but we spent probably more than we had to. But they were not taking any chances with the financial system. The Fed had to make some markets even, and then we had it in 2020, the and there was another big spike in spending. So we had those two events that we took on a lot of debt for. The pandemic, we calculate, cost us about $6.3 trillion between the subsidies that were provided, the efforts to shore up the healthcare system, and the lost revenue to the Treasury Department when fewer individuals and corporations were working and making money. So those are two events that added a lot of debt. But in between that, we got into a habit of spending more than we were taking in. It was too easy to take on debt because since 2008, interest rates were very, very low. You know, the T-bill, there was a time when the T-bill rate was 0.6%. So I think there was no break on borrowing money because it looked like it was virtually free. And we piled up a lot of debt. And as you pointed out, interest rates now have been between 4 to 5.5%. Our debt to GDP ratio is projected to equal what it was at the end of World War II in 2028. That's just 4 years from now. We're projected to go to 106% of GDP again, with not nearly the kind of crisis we had in World War II. And we do face the risk that people won't want to buy our debt, or will only buy it at much higher than the average market interest rates. And that could be a real problem because we have to refund the debt. You know, most of the debt has been financed by the Treasury Department with 10-year T-bills. I can't quite understand why they didn't use some 30-year bonds in the period when we had the pandemic. We recommended that actually they do that.
Or even 100-year bonds, because only the government can do it. What? So your point, but fix it out, but they didn't, and so you're constantly now replacing.
Well, that's exactly what's happening now. They got about 1/10 of the debt has to be refunded each year. That's $3.4 trillion are going into the market,
right,
just to refund the debt. But we also this year are projected to have a deficit of $1.6 trillion. So we're going to have to get that money too.
Well, so this is the issue. I mean, we used to have a budget, total budget spending of around $4 trillion. We took $3 trillion in taxes. It was $1 trillion a year in deficit. It wasn't great, but it was kind of manageable, or people sold us that it was manageable because the economy was growing and, yada, yada. But now, it's nearly $2 trillion in debt. And that's after this big step up that you've talked about with the pandemic of $6 trillion. Hence, we're over $34 trillion and about 100% of GDP. So it's unsustainable from, these rates, these levels that we used to have. But nobody seems to care.
The latest CBO projection just underscores what you said, because they're projecting, and as you point out, their projection is probably conservative, that the average deficit for the next 10 years will be $2 trillion per year, which means in the next 10 years, we'll take on another $20 trillion of debt and bring the total up to $54 trillion. And the interest rates are much higher. So the interest is going to get to be a higher and higher number. And when you're in a debt situation, how do you pay that interest? Well, the only way you can pay it is to sell even more Treasury bills and bonds, right? So the interest adds to the debt, and you pay interest on the interest then.
So what happens? Where does this end, Joe? Because it's not linear, right? I mean, at some point, it's going to stop. People will say, enough. We're not buying this. It's too risky. Even if they haven't had a downgrade, it's too risky. There's too much. And this thing, it can crater. Now, does that create a dollar crisis? Do you revalue the currency? Do you, what happens? What does it look like?
Well, I think the first thing that would happen is you'd see interest rates get very, very high. It'd be very hard for the Treasury to clear its auctions, to sell all the debt it wants to sell, and that it'd be paying very high prices. But the point is going to come. We sell about 1/3 of our debt to foreigners, and the biggest holders are Japan, the UK, China, and they've slowed down their purchases actually already. And I think the other thing that happens is the United States is threatened to lose its stature as the global currency. I mean, there are moves afoot, certainly by China and also the Arab world to have their own currencies. The BRICS want to have their own currencies. That's Brazil, China, India, South Africa, and about 7 or 8 other countries. They want to form their own currency unions. They don't. The dominance of the dollar could easily go away, and we'd be in a debt crisis, our money would be devalued, our costs would soar because the cost of our imports, which we are very dependent upon, would go up. It would be extremely inflationary, and we would run around and try to fix things in a very hasty way. Some of the things that are going to need fixing is Social Security, it's Medicare, and Medicaid too, and I think we need tax reform. We take in last year we took in about 16% of GDP in revenues, and we spent about 23% in costs. So that's a pretty big gap between revenues and costs that has to be financed. That's why we have a $6 trillion deficit.
We're talking to Dr. Joe Kasputys about the U.S. debt. We're going to take a short break and be right back.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to CEO Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by Dr. Joe Kasputys, the CEO of Economic Ventures and a CED Trustee. Okay, so Joe, I just want to go back to this point that you made, that we have a lot of foreign countries buying our debt, right? I mean, and China has been one of the top countries that has owned our debt. I mean, just think about the geopolitical situation right now. You know, they are not necessarily completely friendly with us. They're adversarial. They're talking about making a kinetic move on Taiwan. So this is a difficult situation. What happens when China has this huge portion of our debt and calls the debt and says, okay, well, you know, we're done, pay it back? I mean, that could bring us to our knees. And then, you know, you overlay that with, you know, all of a sudden you run out of space in the discretionary budget because you're paying interest on the debt. You must pay interest on the debt or you don't get any more debt. So it's just this constant downward spiral, and you then have to cut the military, you cut all your spending. At what point then does the country just collapse?
Well, there probably is a point, but I don't think we would let it get there. We would be close to collapse and then frantically trying to shore up the problem, which would be very expensive and disruptive. I will say this, that the Chinese have already reduced their holdings of T-bills. They still have some trillions of it, a couple of trillion of it, but they're reducing their holdings.
Yeah.
I don't see how the United States can expect to be a superpower when it's broke.
Well, this is the point. I mean, the globe, I think, you know, a lot of people in the United States don't have passports, you know, roughly what, 40-50%. They don't have this global view. But when you're sitting outside the United States, as you do frequently, and I do frequently, and you're talking to people and they're looking back in, the global economy relies on the United States. The global peace relies on the United States. The global trade relies on the United States. And this allows, you know, the globe's nearly 8 billion people to rise up out of poverty. It creates democracy and peace. It allows, constant trade. There's so much interaction here that people just don't understand. And so when people say, well, I don't want taxes raised, or I don't, you can't cut my Social Security, or you can't touch this, you've got global consequences here that they're not taking into account.
You're exactly right, Steve. The primacy of the dollar as the world's currency has been a very important part of making the system work and keeping the United States in a leadership position. And I don't see how you can have the primacy of the dollar and still have so much debt. You know, there's a point where you can't even sell it. And we're going to come to that point. We're definitely going to come to that point. All the projections say that. But by 2034, we're expected that the debt to GDP ratio will be 116%. Now, Greece got into trouble when it went over 90%. You may remember that. So did several other countries. Now we're not Greece. We're a lot stronger and more resilient, and there's more value in our economy and more innovation and all. But if you look at a 30-year projection, again, it's probably a conservative projection. The debt to GDP ratio by 2054 is projected to be somewhere between 170 to 180%. That is just outside the range of feasibility. It's not going to happen. The market's not going to let it happen. So the question is, why don't we fix it? We all know that this is coming. Everybody sees these projections. Nobody questions the validity of them, really. They're done on a very sound and conservative basis. The situation's actually going to be a lot worse than is projected. And yet we haven't touched the things that need to be touched. And we know what to do.
And Joe, you and I have been up on the Hill. We've been into the administration, multiple administrations. We've talked to these people, and you're right. Every person, regardless of whether they're wearing a blue shirt or a red shirt, every person understands these numbers. This is not an opaque thing. They know. But every time they tell us, well, we can't do this politically. At what point, Joe, do the American people, do business leaders need to play the adults in the room here and say, okay, guys, it's time. We've got to take some political decisions?
What point was that? Probably sometime in the last couple of years. That's where the point was. We've been trying to get that done for a long time, Steve. And as you say, everybody will privately agree with us, but nobody wants to step out and take the political risk. Look at Macron in France. He wanted to add 2 more working years before the French could retire. And the country was tied up in general strikes, and people were rioting in the streets over 2 more working years. I think they wanted to make the retirement 63 or 64 or something like that. And it's the same thing here. Nobody wants to give up on any benefits. These third rails that you can't touch, like Social Security and Medicare and so forth, have to be overhauled. We can't continue. There's another point I'd like to make is there's 2 kinds of debt. There's the debt held by the public, and then there's the debt that the government holds on an interagency basis. So when you pay into Social Security or you pay your Medicare fees, it goes into a trust fund. Okay. Well, the trust funds don't get to keep the cash. What they do is they exchange it for T-bills. So the trust funds are holding a bunch of T-bills. Well, these programs, the trust funds, are scheduled to run out. The hospital trust fund, Part A, is scheduled to run out in 2031. It looks like Social Security is going to run out because it's paying out more than it's taking in, so it reduces the trust fund. It looks like it's going to run out sometime in 2032, maybe 2033. If we don't do anything to fix it, there's an automatic 23% cut in benefits that would occur in 2033. Do you think the Congress is ever going to let that actually happen and have all the retirees take a 23% cut in benefits? My fear is that they'll turn around and start funding it with general revenues. I mean, they're assuming that somehow they're going to keep it solvent. So they'll again try to sell more debt. What we call debt held not by the public, but intergovernment debt could very easily turn out to be a call on the Treasury again.
Okay, so we can't do this through debt. We're really at our limits. You've made your case brilliantly. So then you've got the other side of the argument, which is that just raise taxes. But then, Joe, when you look at whatever tax rate we've ever had in history, regardless of the tax rate, we've never taken in more than 17 to 19% of total GDP.
That's true. That's right. And we're spending. It looks like we're going to be spending this year about 23% of GDP. That's a spending side. So you still got a big gap. You can't fix it all through taxes. I believe, Steve, we need tax reform. We need to close loopholes. We need to do a better job. And the Congress was kind of onto this, but they kind of used the sledgehammer. We need to do a better job of closing the tax gap, better enforcement, and collecting all the taxes we should. And I believe we don't need to raise rates, but we need reform and we need better enforcement. And
right.
we could add a point or two to what last year was just 16.5% of GDP collected in taxes. I think it would be more reasonable to get it up to about 17.5, maybe even 18.
And some say that you could actually get up to 19 theoretically, but so this is what people don't understand. You raise the rates. When you raise the rates, you take more money out of the private sector that is not there for investments, and you move it over to the public sector. It's very inefficient, and you don't get the multiplier effect. So essentially, then the GDP doesn't grow as much, and so the percentage of GDP is lower. I mean, it's just math at the end of the day, and so what happens is you can't get to that level of 23 to 24% with tax rates. You have to do what you said in tax reform, but then you have to come back to what are the causes of this, and it comes back to Social Security, which is a very fixable problem. You raise the age limit a couple of years, and you do a little means testing, and that one fixes really easy. It's Medicare that is the big kahuna.
Yes, well, Medicare is not as big as Social Security in terms of annual government spending, but it collectively, if you take Medicare and Medicaid and the Child Health Insurance Program and a few other programs like that, you are looking at a big number. We spent about $1.5 trillion on those items, so it's slightly more than Social Security in 2023. So I think Medicare needs a very fundamental fix. It's still too much based on fee-for-service. It needs to have a more competitive marketplace with better exchanges and freedom for the consumer to make a choice of just how much Medicare they want to buy. If you're a young person, you're healthy, you can just have catastrophic insurance. If you're older, you may want more, but to some degree, we have to start paying more for more of these benefits. We have to overhaul it. We've got to also do all we can to drive the cost down. Now, along with that, we've had marvelous increases in technology, and we can deliver more health care and more effective health care, but we have this aging population who is living longer, and there's more of them as a percentage of the population. So it's kind of baked in the cake that it's going to be a struggle for us, because you have more people living longer, and you have more technology you can apply to lengthen life. So it is a struggle, but it has to be overhauled. There are ways to do it.
Yeah, and the inflation rates on these things, when I say it's a big kahuna, it's the inflation rates on these things that kill future budgets. So, Joe, this is a crisis. We can see the crisis. We've got the freight train rolling down the track. When we get to the crisis, we're going to run right into it, right through it, and crash the economy. We still have time on the track to slow this thing down, to make these changes you're talking about. And, a lot of people say, well, we can't do anything without a crisis, and the crisis isn't going to come for another decade or so. So therefore, we got to just wait. And that's just unfair to the generations that Gen Z, millennials, who are going to have to take on these massive changes and changes to society that will affect their lives. So this is where CEOs and business leaders and everyone should be standing up right now and determining to fix this.
We have to speak out. We have to demand that it get fixed. We at the CED, which is part of the Conference Board organization, we've been calling for a new bipartisan congressional commission with a mandate to come up with a plan that'll reduce the deficit and take the debt to GDP ratio to 70%. Now, you can't get there tomorrow. It would take about 20 years of careful, reasoned cuts, reducing the cost of living increases and things of that sort, fixes the Social Security, phase them in gradually. You could phase it in gradually. It wouldn't be that painful. It's all doable if we start now. It was more doable if we started 5 years ago, but it's still doable if we start now. We know how to do this. We have a plan. We have a plan for Social Security, for Medicare, and it could be applied to Medicaid as well. And what I'd like to see is a little more spending on defense. Historically, we've been spending 4 to 4.5% on defense, and now with interest rates coming up to be such a big portion of the federal budget, I mean, we're looking at over $1.5 trillion in 10 years. It's squeezing defense down to 2.5%. Does this sound like the kind of world where we should be spending 2.5% on defense? So, we got to get our priorities right, too.
Well, and every time we cut it, the world gets more dangerous because they sense weakness and lack of stability. Yeah. And so we can't put our heads in the sand, because all it will do is destabilize the whole world and affect those 7 billion people out there. Joe, I think you've made a very worrying case that the time for the solution is now, and people need to stand up. There are some very practical things we need to do, and it is solvable, but we have to do it now. And we really appreciate your leadership in all of this, and thanks for being with us today.
I appreciate the opportunity to speak with you about this, Steve, and I appreciate the good work that the Conference Board does on this problem. It's up to us to stand up to it, and we've got to do it now.
And thanks to all of you for listening in to CEO Perspectives. Every week I'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover the leading topics in economics, public policy, geopolitics, and more. Please share CEO Perspectives with your friends and colleagues and everyone who cares about the state of the U.S. debt. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You have been listening to CEO Perspectives, a podcast by the Conference Board.